Welcome back to another episode. In today's program, we're going to talk about the different types of self-directed accounts that go beyond just a self-directed IRA or Roth IRA, SEP IRA, simple IRA. What about a health savings account or Coverdell Education Savings Account or even solo 401k? Let's get started. Did you know that you could self-direct an HSA, a health savings account? Did you know you could self-direct a Coverdell Education Savings Account or even a solo 401k? So these go beyond the self-directed IRA. Now I'm going to give you an example in just a moment of a client who used his daughter's Coverdell Education Savings Account and made nearly a 1,900% cash-on-cash return on investment in one transaction. So with an HSA or a Coverdell Education Savings Account or a solo 401k, you can self-direct into private market opportunities or alternative investments like real estate, private equity, private real estate syndications, physical gold and silver, and much more. So let me focus in for a moment on a health savings account. So you can self-direct an HSA into private market investments. When you make contributions to an HSA, you get a tax deduction. That's assuming that you qualify for the HSA, you have a high deductible healthcare plan. You contribute, you get a tax deduction. Your growth is tax-free. So imagine being able to deploy that capital into private market opportunities that you select, that you feel confident in, and then all of your returns go back into the HSA and you pay 0% tax. But even better, when you distribute money from the HSA, and you use it for its intended purpose, which is for healthcare expenses, it's tax-free. And by the way, a lot of people don't know about this. Many Americans, they do this. They contribute to their HSA, and then they take money out over the year, all of the money in many cases, to pay for their healthcare expenses. But a lot of people aren't aware of the fact that they can contribute to their HSA, continue to compound that year over year over year, making investments, money going out, money coming in, money going out, money coming back in. And you compound that HSA tax-free, and then you can reimburse yourself for previous periods' healthcare expenses. Meaning, if you had an HSA today and you incurred an expense, you save the receipt, you pay for it out of pocket, you don't use the money from the HSA. You grow the HSA tax-free, and then let's say 3 years from now, you go back in time, you distribute money from your HSA to yourself tax-free, reimbursing yourself for that expense. There's a lot of power behind the HSA and actually keeping money in the HSA. So instead of spending the money every year to pay for healthcare-related expenses, instead keep the money in the HSA growing and compounding tax-free for more of your, if you will, long-term healthcare-related expenses. All right, now let's move into a quick example. A lot of people ask me, well, wait a second, John, with a Coverdell Education Savings Account or a health savings account, or for if I'm a solopreneur and I have a solo 401k, and I'm just starting with a new contribution, I don't have a lot of money in there. How can I go buy real estate? How can I put together real estate-related investments or private market investments with a small amount of money? Well, let me give you a quick example. A client of mine by the name of Lee, he set up a Coverdell Education Savings Account for his daughter. Now, you'll learn with a Coverdell Education Savings Account, you can only contribute $2,000 per year. So the maximum out-of-pocket contribution to a Coverdell Education Savings Account, as we call it in short, CESA account, is $2,000. So he set up a CESA account for his daughter. $2,000 goes in. He finds a property. It was a fix and flip property opportunity. He needed $190,000 for the purchase and rehab of this property. He didn't have, obviously, $190,000 in the CESA account. He borrowed money from two private lenders. He had a lender fund the purchase of $150,000, and then he had a second lender loan $40,000 for the rehab. So it was $190,000 purchase and rehab. The Coverdell Education Savings Account put approximately $1,500 into the transaction. So the Coverdell account put down the earnest money deposit. The Coverdell account had some initial expenses. It was about $1,500, but that was it. The Coverdell only put $1,500 into the transaction. And then he had private money, $190,000, loaned to the Coverdell Education Savings Account. Now, you will learn that this loan, so the loan that the Coverdell took on, the CESA account took on, had to be a non-recourse loan, meaning Lee, on behalf of his daughter's Coverdell account, couldn't sign a personal guarantee. So he made sure that he structured the financing appropriately. So this was a fix and flip transaction. Over the course of 11 to 13 months, the rehab was complete. The property was sold. When the property was sold, they had $251,975.82 flow back in. Now, the Coverdell account recognized initially a profit of $44,875.82. So let's round up and say $45,000. So the Coverdell made a $45,000 profit. That was after the loan was paid back, the two loans were paid back, and then, of course, the interest on the loans, which was about $17,100. Now, the call it $45,000 in profit that went back to the Coverdell account, of course, it would have been great if he could recognize that profit 100% tax-free in the Coverdell Education Savings Account. Unfortunately, but also fortunately, you'll find, because it was still a highly profitable transaction, the Coverdell Education Savings Account is subject to a little-known tax called Unrelated Business Income Tax, UBIT tax for short. In the context of a Coverdell account taking on debt, it's oftentimes referred to as unrelated debt-financed income tax, Section 511 to 514 of the tax code. We actually have additional videos that outline the specifics of this UBIT tax if you want to learn more about it. But for all intents and purposes, the way this UBIT tax works is you have your profit comes back into the account, and then you have to look at the percentage of the property that's debt-financed. So in this case, Lee's daughter's CESA account was nearly 100% leveraged. So the property, he put $1,500 into the transaction, and it was $190,000 purchase and rehab. So he was nearly 100% leveraged. So that means that nearly 100% of that profit is subject to UBIT tax. So then you follow the estate and trust tax schedule at about a 37% tax rate. He'll pay around $16,600 in taxes. So the Coverdell Education Savings Account pays $16,600 in taxes, but the net profit after the tax is paid is about $28,000. So that's $28,000 in the Coverdell Education Savings Account that will continue to grow tax-free, and it compounds year over year, and then he can pull the money out to pay for his daughter's college tuition or even K through 12 education. So that is still, even after the taxes are paid, that is still a 1,900% cash-on-cash return on investment. So what I always like to say to folks is UBIT, UBIT, or unrelated debt finance income tax, that can actually be your friend. In many cases, paying the tax makes sense because now Lee has the tax-free dollars in the Coverdell Education Savings Account that he can go out and do additional transactions with. So that's one example of many that we can provide to you, where a Coverdell Education Savings Account, or you could also do that with an HSA or even a solo 401k. Now, the last piece of this, which is really interesting, is if Lee were to have conducted that transaction with a solo 401k, he would actually most likely be exempt from the unrelated debt financed income tax, because qualified plans such as solo 401ks or just 401ks in general have an exemption related to unrelated debt financed income tax, assuming that the financing is structured properly. We have additional educational videos and materials specific to those nuances. Now, there are many other small dollar related transactions that we routinely see with CESA accounts, HSAs, and solo 401ks. For example, some of you have seen one of the past episodes where I talk about real estate joint ventures. And a client here by the name of Doug with his Roth IRA put about $13,000 into a real estate joint venture transaction, and he made $34,000 tax-free. So he grew his Roth IRA from about $13,000 and some change to over $47,000 tax-free on one transaction. So as we always say, of course, there are rules and guidelines that you need to follow, but you're really only limited by your own creativity. I hope you enjoyed another episode here in the Equity Trust Virtual Classroom. Again, I'm John Bowens, Director of Education and Investor Success. And as always, as I like to leave folks with, remember that financial concept of compounding interest in the absence of taxation.